You're sitting at the kitchen table with your monthly bank statement. The numbers look fine for now, but you're doing that calculation again, the one you do every few months, dividing what you have by how many years you might need it to last. 20 years, 25, 30? Every time you run the numbers, that knot in your stomach gets a little tighter. You want to actually enjoy retirement, not just survive it. But every time you think about spending money on something you'd really enjoy, a trip, helping a grandchild, updating that bathroom, you hear this voice asking, can I really afford this? That tension right there, between living comfortably today and making sure your money lasts. That's what we're going to address. My name is David Harrington. I spent over 2 decades as an investment banking analyst and portfolio strategist, navigating market cycles, recessions, and financial bubbles. After stepping away from institutional finance, I now focus on helping everyday people, especially those approaching or enjoying retirement, understand money in a calm, practical way. Before we continue, a quick note. This isn't financial advice. Everyone's situation is different. Think of this as education to help you ask better questions and make calmer decisions. By the end of this video, you'll understand how to make your retirement savings last longer without feeling like you're depriving yourself, and why the conventional advice about this often misses what actually matters in daily life. If you find this helpful, please subscribe and hit the like button. It helps more people find practical retirement guidance that actually makes sense. Now, let's talk about what stretching your retirement savings really means, and why it's not about clipping coupons or eating ramen. When most people hear, make your money last longer, they immediately think about cutting back. Smaller grocery bills, fewer dinners out, canceling subscriptions. And yes, some of that might be part of the picture, but that's not actually where the big opportunities are. In my years working with retirees and pre-retirees, I've noticed something surprising. The people who make their money last longest aren't necessarily the ones who cut the most. They're the ones who understand the difference between cost and value. Let me show you what I mean. You're paying $1,800 a year for a gym membership you use twice a month. That's expensive, right? Meanwhile, you're not getting your roof inspected because it costs $300. Here's what actually happens. You keep paying the gym membership because canceling feels like giving up on your health. But that uninspected roof? 3 years from now, you're looking at a $12,000 repair that could have been a $2,000 fix if you'd caught it early. The gym membership costs more per year, but the avoided roof inspection costs more over time. That's the difference between cost and value. Stretching retirement savings isn't about spending less on everything. It's about spending smarter on the things that actually protect your financial runway. Here's what I learned watching thousands of retirements. The people who run out of money rarely do so because they enjoyed too many restaurant meals. They run out because of 3 or 4 big decisions that seemed reasonable at the time, but quietly drained their accounts year after year. An unnecessarily expensive Medicare supplement, keeping too much house for too long, not managing required minimum distributions tax efficiently, helping adult children in ways that feel generous but aren't sustainable. These aren't moral failures. They're just decisions made without understanding the full long-term picture. Think about it this way. If you're spending $40,000 a year in retirement and you reduce that by 10% through smarter decisions, not deprivation, but actual optimization, that's $4,000 annually. Over 20 years, that's $80,000 you didn't have to pull from your accounts. But here's what really matters. That $80,000 left invested, earning even modest returns, might grow to $120,000 or more. You just added multiple years to your retirement runway, and you did it without eating less or traveling less or enjoying life less. You just stopped spending money on things that weren't actually making your life better. Let me give you some real examples of what this looks like in practice. Medicare supplemental insurance is a perfect case study. Many retirees get sold Plan F or Plan G, the most comprehensive coverage available, because it sounds safe. And it might cost $2,400 a year. But here's what your insurance agent probably didn't walk you through. Plan N might cost $1,600 a year, and the only real difference for most healthy retirees is you pay $20 for some doctor visits. Let's say you go to the doctor 8 times a year. That's $160 in copays. You just saved $640 annually. Over 20 years, that's nearly $13,000 that stays in your account. Now, maybe Plan G makes sense for your specific health situation. That's between you and your advisor. But most retirees I've worked with had never actually compared the plans. They just bought the most comprehensive one because it felt safer. That's not a spending decision. That's an emotional decision dressed up as a financial one. Here's another one: housing costs. I worked with a couple in their early 70s who were spending $18,000 a year on property taxes, another $8,000 on maintenance, and probably $4,000 on utilities for a 4-bedroom house where 2 bedrooms hadn't been used in 5 years. They loved the house. Of course they did. They raised their kids there. But here's what they hadn't calculated. That house was costing them $30,000 a year just to maintain, not counting the mortgage they'd finally paid off. They downsized to a 2-bedroom condo. Property taxes dropped to $4,500. Maintenance became the condo association's problem, $3,600 a year. Utilities cut in half. They freed up over $18,000 annually. And you know what they told me 6 months later? We should have done this 5 years ago. We don't miss the space. We miss the maintenance bills even less. That's $18,000 a year that can now fund the travel they've been putting off, or help a grandchild with college, or just sit there making them sleep better at night because their money's going to last longer. But here's what's important. They didn't do this because someone told them to cut costs. They did it because they finally understood what that house was actually costing them in terms of years of financial security. Now let's talk about something that makes a lot of people uncomfortable: helping adult children financially. I'm not going to tell you not to help your kids. That's your decision, and it's often the right one. But I am going to tell you what I've seen happen. Parents who give or loan significant money to adult children without thinking about whether it's sustainable over a 20 or 30-year retirement. They're thinking about this year. They're not thinking about themselves at age 85. Here's what most financial advisors won't tell you clearly enough. In retirement, you can't earn your way out of mistakes. During your working years, if you made a bad financial decision, you could work overtime, take a second job, delay retirement a year. You had options. In retirement, your income is largely fixed. Social Security isn't going up because you need more money. Your pension doesn't increase because you overspent. If you drain your accounts faster than planned, you don't get a do-over. That's why every significant spending decision in retirement deserves more thought than the same decision would have gotten when you were 50. Now let's talk about something that sounds small but adds up dramatically: subscription creep. You're probably paying for things right now that you forgot you're paying for. Streaming services you signed up for to watch one show and never canceled. App subscriptions that auto-renew. Magazines you don't read. Cloud storage you don't need. Insurance policies that duplicate coverage you already have. These little charges, $9 here, $15 there, they feel insignificant. But I want you to do something right now, even if you're just thinking about it. Add up every monthly subscription you're paying for. Every single one. Most retirees I've worked with discover they're spending somewhere between $150 and $400 a month on subscriptions. Let's say you're at $200. That's $2,400 a year. Over 20 years, that's $48,000. Left invested at modest returns, that could be $70,000 or more. You just found another year or two of financial runway by canceling services you barely use. And here's the thing, you won't miss most of them. You'll miss that $70,000 a lot more than you'll miss the premium tier of a streaming service you watch once a month. Let me talk about tax efficiency, because this is where a lot of retirement savings quietly disappear. Many retirees don't think strategically about which accounts they withdraw from and when. They just pull money from wherever feels convenient. But here's what that costs. If you're pulling exclusively from tax-deferred accounts like traditional IRAs and 401(k)s, you're paying ordinary income tax on every dollar. Meanwhile, you might have Roth accounts that could be withdrawn tax-free, or taxable brokerage accounts where you'd only pay capital gains rates on the growth. The order in which you withdraw from different account types can save you tens of thousands of dollars over a retirement. Sometimes it makes sense to do Roth conversions in lower income years before required minimum distributions kick in. Sometimes it makes sense to pull from taxable accounts first to keep your income low enough for lower Medicare premiums. Sometimes it makes sense to delay Social Security and live off investments to maximize your lifetime benefit. These aren't strategies you can just implement yourself. You need to work with a financial advisor and a tax professional who understand retirement tax planning. But I'm telling you this because many retirees don't realize this optimization is even possible. They're just paying whatever tax bill arrives without questioning whether there's a smarter way. A good tax-efficient withdrawal strategy might save you $3,000 to $8,000 a year, depending on your situation. Over 20 years, that's $60,000 to $160,000 that stays in your accounts instead of going to the IRS. That's real money. That's years of financial security. Here's another place where retirement savings stretch or shrink: healthcare costs before Medicare. If you retire at 62, but Medicare doesn't start until 65, you're looking at 3 years of private health insurance. And if you're not careful, that can cost you $20,000 to $30,000 a year for a couple. I've seen people burn through $75,000 of their retirement savings just bridging those 3 years. That's a significant hit to accounts that need to last potentially 3 more decades. But here's what many people don't explore thoroughly enough. COBRA continuation from your employer might be expensive, but sometimes it's your best option. Healthcare marketplace plans with subsidies might be surprisingly affordable if you manage your income carefully in those years. Health savings accounts from your working years can be used tax-free for medical expenses. Spousal coverage if your partner is still working. Part-time work just for the benefits. The people who stretch their retirement savings aren't necessarily the ones who never get sick. They're the ones who thought strategically about healthcare coverage during those bridge years instead of just panic buying the first expensive plan they found. Now let's talk about something that sounds counterintuitive: spending money to save money. Sometimes the smartest financial move in retirement is to spend money now to avoid spending more money later. That roof inspection I mentioned earlier, that's a perfect example. Preventive dental work before problems become emergencies. Home maintenance before small issues become major repairs. A financial advisor's fee that saves you multiples in tax optimization. These aren't expenses. They're investments in not having bigger expenses later. I worked with a retiree who kept putting off a $1,200 furnace tune-up and repair because it seemed expensive. 3 years later, the furnace died completely. Full replacement, $8,500. If he'd done the repair, that furnace probably had another 8 to 10 years. Instead, he's out $8,500 in his late 70s when he can least afford it. That savings of $1,200 cost him $7,300. This is what I mean by understanding the difference between cost and value. The question isn't, how much does this cost right now? The question is, what is avoiding this cost me over time? Let's talk about inflation for a moment, because it's something retirees worry about constantly. Yes, inflation erodes purchasing power. Yes, what costs $40,000 a year today might cost $60,000 in 15 years. That's real, and it matters. But here's what I've noticed. Retirees often make themselves crazy trying to beat inflation with aggressive investment strategies that expose them to risks they can't afford. An 80-year-old trying to generate 8% returns to beat inflation isn't being smart. They're being dangerous to their own security. What actually protects you against inflation in retirement isn't aggressive investing. It's sustainable spending patterns that give you flexibility as costs rise. If you're spending $50,000 a year and you really only need $42,000 for your actual baseline life, you have $8,000 of annual flexibility. When inflation hits, you can cut the discretionary stuff without damaging your quality of life. But if you're already spending at the absolute minimum, inflation devastates you because you have nowhere to cut. Stretching retirement savings isn't about living at the poverty line so inflation can't hurt you. It's about building enough margin in your spending that you can adapt when costs rise without panic. Here's something else people don't talk about enough: the emotional cost of bad financial decisions. I've worked with retirees who made their money last by being so anxious about every purchase that they stopped enjoying retirement entirely. They had plenty of money. They just couldn't bring themselves to spend any of it because they were so afraid of running out. That's not financial success. That's a different kind of failure. The goal isn't to make your money last by being miserable. The goal is to understand your true financial picture clearly enough that you can spend confidently on things that actually matter to you, while cutting ruthlessly on things that don't. Confidence comes from knowledge, not from deprivation. Let me give you a framework that actually works. Start by calculating your essential expenses, the things you absolutely must pay every month. Housing, utilities, food, healthcare, insurance, property taxes. Add it up. That's your baseline. Now look at your guaranteed income. Social Security, any pension, annuities. Does your guaranteed income cover your baseline? If yes, you're in a strong position. Your investments just need to fund discretionary spending and inflation protection. If no, you need to think very carefully about either reducing baseline expenses or ensuring your investments can reliably generate the difference. Next, look at your discretionary spending: travel, entertainment, hobbies, gifts, dining out. This is where you have leverage. This is where you can make your money stretch without sacrificing real quality of life. Because here's the thing, cutting your baseline is painful. You feel it every day, but optimizing discretionary spending, that's just making smarter choices about what actually brings you joy. You might discover that you spend $6,000 a year on restaurants, but you'd be just as happy spending $3,500 if you were more intentional about it. You might realize you take 2 big vacations a year, but you only really enjoy one of them, and the other is just habit. You might find that you're buying gifts for grandchildren that they don't particularly want or need, when what they'd really value is time with you. Here's a question worth asking yourself. What are you spending money on out of habit versus genuine enjoyment? That country club membership you've had for 30 years, but only used twice a month? That's probably habit. The woodworking equipment in your garage you haven't touched in 2 years? Habit. The cable package with 400 channels when you watch 8? Habit. These things aren't making your life better. They're just familiar. And familiarity is expensive in retirement when you're trying to make money last. Now let me talk about something that makes people uncomfortable but matters enormously: your withdrawal rate. The classic rule says you can withdraw 4% of your retirement savings annually, adjusted for inflation, and have a strong probability your money lasts 30 years. That's a reasonable starting point. But it's not gospel. If you retire at 62, you might need to plan for 35 or 40 years. That 4% might need to be 3.5%. If you retire at 70, maybe 4.5% is fine. If your spending is inflexible, you need to be more conservative. If you have flexibility to cut back during down markets, you can be slightly more aggressive. But here's what really matters. If you're withdrawing 5% or 6% or more, thinking you'll just figure it out later, you're not stretching your retirement savings. You're compressing them. You're shortening your financial runway every single year. And at some point, probably when you're in your 80s and least able to recover, you're going to run into a crisis. The math is brutal and non-negotiable. If you're pulling 6% annually from $1 million portfolio, you're taking $60,000 a year. That portfolio needs to earn more than 6% every year just to stay even. And it needs to earn significantly more to keep pace with inflation. Some years it will, many years it won't. And the years it doesn't come early in your retirement, that's called sequence of returns risk. You might never recover. Sustainable withdrawal rates aren't optional recommendations. They're mathematical realities. Ignoring them doesn't make you optimistic. It makes you broke at 85. Let's talk about Social Security timing, because this is one of the biggest levers you have for stretching retirement income. If you claim Social Security at 62, you're taking a roughly 30% permanent reduction compared to waiting until your full retirement age of 67. If you wait until 70, you get an additional 24% increase beyond your full retirement age benefit. For someone whose full retirement age benefit would be $2,500 a month, that's the difference between $1,750 at 62 and $3,100 at 70. Over a 30-year retirement, we're talking hundreds of thousands of dollars in cumulative benefits. Now, should everyone wait until 70? No. If you have health issues and don't expect to live into your 80s, taking it early might make sense. If you need the money and have no other income source, you take it when you need it. But if you can afford to delay, if you can live off savings for a few years or work part-time, every year you delay increases your lifetime income significantly. I've worked with couples who claimed early because we wanted to start getting our money back from the government, and then watch one spouse die at 75, leaving the other with a reduced survivor benefit for potentially another 15 or 20 years. That decision to claim at 62 instead of waiting cost the surviving spouse hundreds of thousands of dollars over their lifetime. You can't undo that. It's permanent. Here's something most people don't think about. Required minimum distributions at age 73 can force you to take more money out of retirement accounts than you actually need. If you have substantial tax-deferred accounts and you wait until 73 to start distributions, you might be forced to take $40,000 or $50,000 or more annually, whether you need it or not. That pushes you into higher tax brackets. It can increase your Medicare premiums. It can make more of your Social Security taxable. It's expensive. But if you plan ahead, if you do strategic Roth conversions in your 60s when your income is lower, if you spend down traditional IRA accounts earlier rather than later, if you think about tax diversification before RMDs kick in, you can significantly reduce this problem. You might save $50,000 or $100,000 in lifetime taxes just by being strategic about when and how much you convert. This requires planning with a financial advisor and a CPA who understand this stuff. But it's one of the most effective ways to stretch retirement savings that almost nobody does. Let me talk about long-term care for a minute, because this is where retirement plans often completely fall apart. Nursing home care can cost $100,000 a year or more. Memory care, similar. Even in-home care can run $50,000 to $70,000 annually. If you need care for 3 or 4 or 5 years, that can devastate even a well-funded retirement plan. But here's the problem. Long-term care insurance is expensive, especially if you wait until your 60s or 70s to buy it. And many people can't qualify medically by that point anyway. There's no perfect answer here. But what I've seen destroy retirement after retirement is people who don't plan at all. They just hope they won't need care. And when they do, they burn through $300,000 or $400,000 in 3 years and end up on Medicaid anyway. Except now they've depleted everything they hoped to leave their children or use for the surviving spouse. You don't have to buy expensive insurance, but you do have to have a plan. And that plan needs to account for the possibility that one or both spouses might need significant care for multiple years. Ignoring this doesn't make it less likely. It just means you'll be completely unprepared when it happens. Here's what I want you to understand. Stretching retirement savings isn't about sacrifice. It's about clarity. It's about understanding what you're actually spending money on and whether that spending aligns with what you value. It's about making strategic decisions now that protect your financial security later. It's about knowing the difference between cost and value, between what feels good today and what serves you over decades. You don't want to be that person at 82, looking at account balances that are terrifyingly low, wondering where it all went. You want to be the person who understood this stuff at 65 or 70, made smart adjustments, and now at 82 still has plenty of margin and security. That difference comes down to the decisions you make today. Not deprivation, not misery, just clear-eyed understanding of what your money needs to do for you over the next 20 or 30 years, and then structuring your spending and withdrawal strategy to make that happen. Your future self, the one who's 85 and either comfortable or anxious, is counting on the decisions you make right now. The knowledge is available. The strategies exist. The only question is whether you'll actually use them. Start today. Review your spending. Talk to your advisor about tax-efficient withdrawal strategies. Think about Social Security timing. Look at your healthcare coverage. Calculate your true withdrawal rate. Understand what you're paying for subscriptions and services you don't value. Make 1 or 2 strategic changes that protect your long-term security without destroying your quality of life today. You don't need to fix everything at once, but you do need to start. Because every month you wait, you're either stretching your retirement savings or compressing them. There's no standing still. The choice you're making right now, even if you don't realize you're making it, is which direction you're moving. Make it count.